I think that should do it. We can go ahead and get started, and people will trickle in as they do. But this will commence on how to choose a real estate market in a post-COVID world. So I'm going to be going over what the metrics you want to be looking for, what is the data points that you're looking for when you're analyzing a market, and how do you determine it's the best market to invest in, right? What markets are going to net you the most profit at the end of the day, right? What are the safest markets to invest in, and what are the things that are going to lead you to come to that conclusion, right? So we're going to be looking at 5 main metrics and then the specific criteria for those. And then I have 3 additional metrics that I've added for sort of this post-COVID environment that we're dealing with now, because I think there's some specific considerations that you have to give due to this specific recession that maybe you wouldn't have for previous ones, right? It's a little bit different. So a lot of this, if you guys are familiar with Neil Bauer, a lot of this comes from his Real Focus system. He kind of is responsible for a lot of my mindset towards a data-centric real estate investing. So some of this might look familiar, but like I said, I've kind of added with that COVID data that I think is going to be really important. So the way I've set this up, it's kind of a 2-parter. So you're getting a 2-fer here. So first, I'm going to go over those specific metrics, what they are, what you want to look for. And then part 2, I'll share my screen and I'll actually walk through a city kind of as a case study. So I'll show you exactly where to find that data, how to find it, how to go about getting all this data compiled, so that way, figure later on, if you guys want to refer back to this video as a reference, you'll know, okay, I just want to go to part 1 because he said something there, or what was that website that he was showing me? And then you can just go to part 2. So let me know if that works out for you guys as well. Maybe that's something I'll kind of keep as a trend. So, all right. Before I get into it, some people are new to this stream, so just to introduce myself, originally from the Boston area, and I went into the Air Force after college. So my background is actually military aviation. So I flew the B-1 bomber in the Air Force. I was active duty for 8 years. And while I was active, I was stationed up in Rapid City, South Dakota, which is where I bought my first rental property. So my first property I ever bought was a duplex. And I did the house hacking, if you're familiar with that term. So I had a tenant in one side, and then me and my roommate lived in the other, and that covered all my bills. So that kind of started my interest in real estate investing, and sort of snowballed from there into other rental properties and so on. So that's where I am today, where I'm just full-time focused on real estate investing. A lot of what's afforded me that opportunity, though, is my early investments in cryptocurrency. So way back in 2013, when everyone thought Bitcoin was this big joke, I put a fair amount of money into Bitcoin, and it's done really well. And I bring it up, it's especially relevant today because it is approaching $16,000 as we speak. Last time I checked, like an hour ago, it was about 15.5, 15.6. So huge run in Bitcoin this month. It's gone from about 11, 12,000 up to almost 16 in like a month. So Bitcoin is looking very bullish right now. There's a lot of movement. There's a lot of companies and institutions moving into it. So if that's of interest to you, we can chat about that another time, but it's kind of a fun topic. All right. Also, a couple very important announcements. First of all, let you guys know I got a new haircut yesterday. Does it look good? Probably the best haircut I've ever got. I got like 8 inches chopped off. I used to have really long hair, but I'm pretty excited about it. So I want to share that with you. I know what you're thinking. It's a lot of sex appeal for a mid-afternoon real estate webinar, but you know, that's showbiz, baby. What can I say? All right, no, but in all seriousness, I do have an announcement. So my partners and I have had an LOI accepted on a 232 unit Class B apartment building in Houston, Texas. So really excited to move forward with that. We should have the final PSA sorted out in the next week or 2. So I can't give too much details on it, but it's a high quality value add investment. Class B, Houston's a great growing market, one of the top markets for investing in the US. So really excited about that. If you're interested in hearing more about that, definitely let me know. If you're looking for investment opportunities, we can talk about that. And just look out for that. I'll be shooting an email out probably the next week or 2. So thank you, Sonny. I'm excited. It's pretty sweet. All right. Without further ado, I think we can get into it. So let's start. How to choose a real estate market in a post-COVID world. All right, having fun with this one. All right, so number one, population growth. So this is extremely important. You want a growing city, okay? A growing city is a healthy city. It's a strong city. So population growth is one of the first things you want to look for. So what you want to see is from the year 2000 through about 2018. And the reason I say that is because that's where you're going to get data generally is for 2018. So there's kind of a lag in a lot of this data, but the metrics, cities are slow to change. So the metrics work as long as you're doing it right up to 2018. You don't need to readjust it for the last, year and a half, 2 years. But what you want to see is 22% growth from the year 2000 to 2018. Okay. So that's going to ensure that it's a growing city. And like I said, it's going to be healthy. So that number is for a city that's about 250,000 to 1 million. So that's kind of the sweet spot where most cities are going to fall into. Now, if it's a bigger city, one of the chief metros, if it's above 1 million, basically, that number drops down to 16%. So you go from 22% down to 16% if it's greater than 1 million in population. If you're below that 250,000 cutoff, that number jumps to 31%. So because you're in a smaller market, there's a little higher risk. It's more exposed to, a single employer moving out and pulling a bunch of jobs or something. You want better population growth so that you have more of a tailwind helping you out in that smaller market, But there is, there's a lot of advantages to avoiding those smaller markets. A lot of people won't invest in a city that's less than 200, 250,000 because those bigger cities are going to have just a larger pool of quality tenants to pull from. And also for staffing, it's a lot easier to find a property manager, a maintenance guy in a city of, 500,000, 750,000 versus a city of 75,000, right? So that's something I've personally experienced investing in Rapid City. It's tough sometimes finding good help, right? So that's number one, population growth, 22%. That's really easy to find. Just go on Google, type in Charlotte population, and it pops up right there. So easy peasy. All right. Number two, median household income. So the next 4 or 5 metrics that I'm going to show you, get them at citydata.com. That's a really good reference. They have excellent data on there. You get a really good snapshot of every city, right? So they're going to show you median household income, the growth from 2000 to 2017. And what you want to see is 31.5%. Okay. So mostly that's keeping up with inflation. So you want to make sure they're at least keeping up with inflation for the most part. But also because if there's no income growth, then you're probably not going to have any rent growth, right? Because people aren't going to be able to pay for it. So that's where you run into affordability issues in a city, is if you have rent growth, but you're not having income growth that keeps up with it. So that's why median household income is really important to track. So like I said, 31.5% is what you're looking for from 2000 to 2017. And then every year after that, you're going to add about 1%. So next year, when you're looking at 2018 data, add 1%, 32.5% for that. So, all right. So that's number two. Number three, median home value. So for this one, you're looking for 42.5% from 2000 to 2017, right? So you see the kind of trend: population 22, household income 31, median home value 42. So kind of easy to remember from that standpoint. So a growth in home value, that's just indicative of a strong market, a healthy market, strong demand, right? So typically rent growth will lag home value growth by 12 to 18 months. So if home prices are going up, you can expect that rent is probably going to follow, right? So because there is such high demand for housing, right? And then with that one, you're going to add 2.5 to 3% a year for every year after, right? This year was a particularly strong year. So some might be thinking, okay, we're going to add 4 or 5%, but just remember that data is lagging. So we won't be showing 2020 data until, a couple of years from now, right? But yeah, that metric works. So, all right. So that is Number one. All right, number two. Excuse me, number five. Man, my notes are all messed up. Sorry, guys. All right, number four, crime. So also getting this from citydata.com, right? So if you scroll down on city data, there's going to be a table that shows you the crime data for that market, okay? It's going to show you all the murders, the rapes, the burglaries, the car thefts, right? But you don't have to get into the nitty-gritty weeds with that. Just look at the very bottom, they're going to have their crime index, right? So I don't know the specific algorithm for how they come up with that, but generally what you're looking for is that kind of bottom number to be below 500. So if it's below 500, it's a pretty safe city, pretty high quality city, right? But you also want to go back a few years and look at what the trend is, right? So if a city is on a consistent trend down, that's a really positive sign. That's probably really good for real estate, right? If it's trending up, that's not a good sign. That's something going on in that city that's causing it. And, you know, a lot of times that can be affected by, you know, education is a big one, I think. If we have poor education, I'll show you later. Albuquerque is a city that struggles with crime, and they have some of the worst education, high school graduate rates in the country, right? So a lot of times that goes hand in hand. So, you know, you can look at what is the city doing. If they're making those investments in education long-term, that could have a net positive effect, right? But again, look at the trend, because maybe it's 400, but if it's been trending up for the last 5 years, maybe that's different than a city that's 600 and has been trending down for the last 5 years, right? So, you know, kind of take a look at that. Not looking just at today, but looking ahead to tomorrow. All right. Number five. So this is a big one. Job growth, super important. So job growth is kind of the heart of your market analysis, right? If there's not job growth, that's not a good sign for that city. So what you're looking for is 2% annualized growth. And where you're going to find that is there's a government website. And again, I'm going to be going through this. So I'll show you that website exactly, but it's departmentofnumbers.com, or maybe it's .org. And you're going to be looking for the annualized rate, which is when you're in there, it's on the far right side, but you're looking for 2%. Now, right now we find ourselves in sort of this awkward moment where everywhere is experiencing job loss for the most part. There are actually some markets that have had job growth, which is interesting, but for the most part, most places are going to be showing job loss right now, right? So you kind of want to go back to pre-COVID and look at what was the trend, how were they doing for the last year, and then, you know, looking through that lens at their unemployment, right? So, okay. So the way you do that is you use the Wayback Machine. Again, I'm going to be showing you how that works. And, you know, you want to look for consistency. Look for those markets that are consistently growing in job growth. And that's going to be a positive tailwind. That's going to show you, okay, this is a solid market that I can invest in, because, you know, jobs attract people, people attract jobs in a way, but jobs are going to attract people. That's going to help your population growth. And that's going to increase demand, because generally you can't build enough to keep up with growth. It's just a sad fact, right? So that's what often drives rises in home prices and rent, of course. So look for those consistent winners. All right, so that's sort of the baseline. Now talking about a post-COVID world, some of the things you're going to be looking at specifically that maybe prior to that weren't as important. So number one top thing is unemployment rate. So, I mean, this was probably something you were always going to look at, but generally there wasn't too much, I guess, weight put on it. But now it's a lot more relevant, right? So you're going to want to look at where it stacks up compared to these other cities throughout the pandemic, because some cities performed a lot better than other cities. So Las Vegas is going to be doing a lot worse because they're hotels and convention centers. So they're not having live events. So a lot of people lost their job. They have high unemployment. So Las Vegas, probably a market to stay away from until it starts to recover a bit. Whereas other markets are chugging along and doing just fine, right? So ideally you want it to be below the national rate. So the last month's jobs report was about, I think, 7.9%. So if it's below that, that's pretty gravy, I would say. If it's above that, that's not a deal killer for sure. If it's within, maybe 2 or 3%, I think that's still okay. But when you get beyond that 2%, that's where you kind of got to proceed with caution and start to take a deeper look at, what is the underlying effect of that unemployment, what's causing that, right? So that data is also readily available. Bureau Labor Statistics puts that out for each metro. Also, I'll be showing you some articles from Wallet Hub. Wallet Hub has been putting out some great studies throughout this pandemic. So a lot of the stuff I'll show you today comes from Wallet Hub, and then some various other sources as well. All right, so kind of building on that, you want diversification of employment, all right? So not human diversification, but employment diversification, all right? You want a wide array of industries in a city. You don't want a city that is relying on a single industry. Like, I don't know, maybe Midland is maybe heavily leaning on oil, maybe not a market you want to be in. You want to be somewhere where it's diversified. So for me, my kind of rule of thumb, and this held true pre-COVID, was I don't want to see more than 15 to 20% of a single industry holding the jobs in that market, right? So maybe there's some times where that doesn't apply because maybe it's just an industry that is really bullish, maybe medical or something. But generally, if it's more than 15%, you just have a large exposure to that industry. So if that industry has an industry specific recession, then that can be bad, right? So right now, industries that I think are good to have. So bonus points for medical, biotech, tech in general, and some of those professional services, finance, things like that. They're going to perform pretty well throughout this versus basically travel and leisure is the big one to avoid. So if it's a big travel, like I said, Las Vegas, hate to pick on Vegas, but that's probably the worst affected by this whole shutdown because their whole economies run on hotels, casinos, conventions, that sort of thing, right? I think it's like 30% of the jobs in Vegas, I think, were hospitality related. So, that's a huge exposure. I do wonder if maybe there's some exceptions to that with drive-to markets. So we are seeing a trend where people, instead of flying to go on vacation, are driving. So one market that I thought about, and I haven't looked into this, but Pensacola, maybe someone can look into it. Pensacola gets a lot of vacationers from Alabama, Georgia, Louisiana. They're not flying in, they're just driving down to the coast to spend a week at the beach or whatever. So that could be, a market that's an example of having a, kind of COVID resilient hospitality sector because more people are just looking for those kind of smaller vacations. But, you go to the beach, you can still social distance at the beach, just find a secluded spot on the beach with your family, bring a cooler beer or whatever. Yeah, that could do really well. So, and this is another one. Wallet Hub had a great article, so I'll show you that, and they've got great tables as well. All right. Number 3 is the fiscal health of the city. So this pandemic has caused a lot of kind of mayhem with city budgets and state budgets as well, because, they're spending a lot of money, but they're not bringing in as much money as they were, right? Their tax revenue is decreased. So if a city has budget issues, especially if it had budget issues prior to COVID, that's a bad sign. So towns can go bankrupt. It's not a good look, right? I think Stockton famously went bankrupt, and there's been a lot of talk about like Chicago declaring bankruptcy. So, that's something that could lead to higher taxes, right? So Nashville, looking at you, Nashville upped their property taxes by 34% this year. So that's a big gain. Nothing to, that's one to write home about. So 34%, that's a big bump. I don't know exactly how they do their assessments. So maybe it's only on sale, or maybe they do it every 5 years. Every market's different, but yeah, that's one that should catch your attention. So, kind of look at that, and maybe that can lead you to prepare for that eventuality, especially if you're just already in one of those markets. And the other thing is, as cities have decreased revenue, they're able to provide decreased services. So it kind of makes the city maybe less appealing if they can't provide the same services that they once were, right? So, so yeah, does that mean Nashville's having a budget problem? Yeah, big time. So they're trying to boost their income. Basically, I think what was going on with Nashville was it was so poorly managed that the state said, "Hey, you have a year to figure this out, or we're just gonna take control of the city finances and kind of run the city for you." So um, that was what they did. They said, well, austerity measures, they could happen, but they're, I guess, less popular than just raising taxes, kind of a quick fix. So I guess that was their quick fix: bump property taxes 34% and hope for the best, I guess. So, okay. So that is part one. So now we're going to move on to part two, and I'll screen share and I'll kind of walk you through each of these and show you exactly how to find that data and what it looks like and where to find it, right? So cool.